Now we are going to discuss the capital allocation process. Again, in raising the capital, the market system will facilitate the coming in of capital from those who have surplus in their money. Like for instance, the Microsoft, they have like 122.8 billion in cash accumulated since the beginning, and there are some corporations that are in need of money. So that's how the capital allocation works. For those in need of money, they go to the market system, financial markets, and for those who have money, they go to financial markets in order to invest. Because if they just retain the money as is, so there's no growth of that. This is also true for the individual who have excessive money. For instance, Carol Hulk has 36,000 gross income in the year, and her expenses is 30,000, and has savings of 6,000, for instance. So the 6,000 will now be available for the investment in the capital markets or in the financial markets. So the purpose of that is if you have surplus and there is a financial markets, you can invest in there so that it will grow and you can secure your future when it comes to the financial security. This is one way on how to make your savings not stagnant, and you can help the economy of pushing it through and or boosting by providing capital in the financial markets, and those who need the capital, they can produce their services or product because of your capital that you have invested. In the financial markets, we can have a direct transfers of money and securities. So as shown that this section occur when the business sells stocks and bonds directly to the savers. For investors, they have two options. They can be lenders or they can be investors or equity holders of a certain corporation. So there are separate or different risks that are attributable to that and also the return. So when you say, if you're a lender, so you can secure an annual interest of something provided in your contract, and also, and when it comes to liquidation or what you call this one or bankruptcy, you are the priority over the others when it comes to the liquidation. Now, when it comes to the investors could have an opportunity to have a return more than what the lenders are receiving, but also the risk is too high. And so if you're investors, you're going to weigh if this particular company, if the risk is really lower than what is than the what you call this one than the return, then it would be good for you to invest in that company. So figure 2.1 shows the diagram of the capital formation process for a business. So this is one is the direct transfer. You can buy directly the securities stocks if you want that. It has a higher risk but also a higher return. Or you can buy bonds, have a lower return and also lower risk. Okay, the savers or that one with the surplus gives the dollars, and while the business will issue the stocks. So if you're buying stocks, you will become an investor, become or equity holders. So depending upon the interest that you have, you could have some influence if you have like more than 50% of the total interest of the stocks. So you have control over the company if that is the case. In the second one, this is indirect transfers. You will need some investment banks to do your buying, and they can, of course, get some financial, commission with that. But that's the same mechanics. You can get securities, and then you will provide dollars of that. And indirect transfers, also, we have some financial intermediary, and this is similar with the banks also. Okay, but financial intermediary it's like that you are not directly in contact with the corporation. Is that the decision over the allocation of your investment is on the financial intermediary, such as the bank, the insurance. Is not concentrated in one investee or a corporation. So they're going to manage your investment in order to minimize the risk of that. So that they call that one as the diversification. Unlike with this one and the second, we have the middle, but the middle is an investment bank. They just act as underwriter. So it's like an agent but of course, you are transacting directly into the bank, and you have the the prerogative on where to invest your funds. Unlike with this one, they have they're managing your finances in order to maximize the value of, or the value of the return out of your investment. The investment bank will earn something if they can sell the securities that are sold coming from the corporation of the shares at a higher price. So they take the risk. So meanwhile, they have that, what we call this one, a certain period of time that they can hold the securities until that the stock price of the securities are favorable to them. Then until such, they can sell that to to the buyer and gain something. Okay. This third one, the financial intermediary, is not acting like that. It's like that they're receiving commission in the transaction, but they are going to, what they call this one, to manage your investment, and they have the discretion in allocating the investment over the opportunities that are available in the financial markets. So they call that one as portfolio because it composed of several investment in a particular. So they try to group the investment in order to to minimize the risk involving in the securities. So understanding about the financial markets is that the financial market, if we have an effective financial market system, it can boost the economy actually. So that's why in the economic development, it really needs the support coming from the financial markets. It's because that's only the venue where the savings and surplus coming from the investors or potential lenders, or yeah, they can provide that, invest that in there. If there's no such financial markets, then they can just hold their funds and nothing will happen to to the economy. So for a well managed financial markets, or organized, if they're a well efficient financial markets, you can see also that the economy of that particular country is also good, or at best situation.